Calling ambulo luku with whatever we do. Jioni safu no la with whatever we do. Hallelujah. Nyepamne ne kudlukula. Nyepangi na kudlukula. Kinongoto ni beti sola. Ibulo kenda to ni betoto.
Bengi Congo.
Lamin.
Na?
Lali ke jibe norin te nyame Lamin.
Kama na wulo kono.
Wulo kono nyinte mo Lamin.
Fabilenki.
Muna ngata afongole. Ngata. Koto le. Fabrama.
Mingi. Baba nyola.
No, koto le.
Wala kan kuma ni ten.
Fabrama.
Jumala mu.
Ndele bari.
Lunda.
Famo kata.
Jamani mbere.
Alindo ko.
Jamani.
Bari koto man kontande.
Bari jamani fana na ramudu wa man kontan.
Koto minaka ngalamin de fom filitala.
Lamin ila sira sama na binki. Yala so dol sayni no ko mo lokko momo.
Koto.
Nam.
Ite in hakilo diata bake karamungoto. Anu santeng ministry ko di ngole si suwo ko amanke ko do
Sibitu.
Bagona ringa.
alani ko kede namo balo
alani na ko na karta bulo be dam alani je.
Ngodo.
Nam.
Ngoto mon kontan feren.
Jamani mu nekata.
Ite ka Lamin ki wulo ko no nyin. Palo Lamin nyande ala karango.
Jamani ka. Fasi.
Karango wal man ko. Nda amanke ko holiday lem. Ngodo. Dini ngo nyanta silala ala karango la mo yamen kamen fu. Kontande man kontan anda mande.
Allah nyin kombo kurang adanda la kombo len la jankara mungol soron dar doron kamen kurang mara do la kombo e ko ndol fana na kara mungol soron je kara mungol soron Lamin adara lo nyino la aman tara fena sokon ala munekela
Lamin ite foyde malon ko lesinol be ke kar radio
Nga fine.
e ko nyani mo Lamin
bir kabin bina kan tambita nteri ma ko ala dinngol
manan tambira jele ni subala ngaje dinngol be jet talanta nen kili warol e be serin jelet
sa Lamin farante ku kili ko no la ba Lamin bita ka wulo ko no nyin tay mo Lamin
aman dara fenela
ite dine ko ni man si yakari lesinol la moy radio te balon na
mu nek
alon telentel jikot
afone
be jikritel kele yaaje nata ay tarije
par ñarande kombo kurang ho findira kombo ide na rajete ni sonka bay ko Lamin manyata la wulo adu karam
ngoto wole nati ba ngalle ni Lamin kunta kombo kurango e ka aso ko e sisu kono bari ni ko e sisu kono be karangol dike la radio lin telel to nyaay man tele soto da bongo bar radio be bulen koto ay si ay alamo
sa do kala
nyaadi ta ro bulaji
ado kala nyaadi
kamun ke nyaadi
muna fala
ndol
radio ko men ka karam
ila subject no baby jele baby jele
wala nan ka coco moy fa dan so wolya ngombe tambi kana ngadi ni wolde be ikadum bungo ko kana ma mo
asoto ta
wala de
Ideal ko inde
muna ni ko ni tamba ndele sin lo ne ba
mbasa mba foke nkoto wole fango ye mulindi yalo famo keta bat yu fana bulata ko no me yen nati jambi Lamin nyan jiko be nyineka ya bulay kila ya bambalo yo be bulaje nkoto dinni ngoy si ayala le sinol la moy radio
mon soro Lamin nyana kara si so na radio
la silale ayala le sinol
dal ko
kila ya
ma be ngala ko momo baro sa no woro radio ni abe jele baro ngamro do man dembe guljan dala nyara nyar fo ko fendi mo la
nkoto barate ku folo ajibe nori nya labi tamete ku
Mingi muna na rin.
teku
bari nkoto famo ke
ja image nañu ñambol si je le ke je ki no le kafun nyoma bari ñambu kino ni manya na ka finde ni nambe ko rozon la ga
ade be ñambo do
ara ni ko jara nata
nkoto bari famo ke da
ngata tambi bungono jara me koto ke baru nganda ni pelo la dija
iyo awa beter la
bungono bismillah bisu diara
ye fongo tanka sina dolu tanka koro ta koro
Hello, viewers and listeners. My name is Siri New Account, and today, before our next, I'd like to the assignment that I gave you under the section of identify the account to be debited and account to be credited. So it is very important for a student to know the account to be debited and the account to be credited in a given transaction. But before we even identify the accounts to be debited and the account to be credited, I will first of all recap of what we discussed in our previous lesson, and that is the 3 steps that we. Step number 1 will be we identify the accounts involved. The accounts involved. That's step number 1. Before we do we debit a particular account or we credit a particular account, the first thing we need to do is we must identify the account involved in a given transaction. Because if you're given we must identify the accounts first before we move to the next. After identifying the account, for instance, let me give an example. For instance, letter question we have on the screen, that's letter A. Say started business with 5,000 in the bank. So the first thing you need to do, I am going to do it step by step. The first thing you need to do is to identify the account involved. And according to accounting, whenever we see started business, it means capital, because that's the definition, that's the meaning of capital. Capital is what the owner invested to start a business. So therefore, whenever we want to commence a business, the resources, the owner have to invest resources in order to start that business, and those resources become our assets. So the first thing we need to do in order to identify the account to be debited and the account to be credited is we have to follow the first principle. We identify the account involved. If the identification is wrong, know that whenever you debit one account and credit the other one, obviously it is also going to be wrong. That is why the students should understand the first step, then they move to the second step, and then the step. So to identify the accounts involved. And here, according to that first transaction, started business is represented by capital. That's and they started into the bank. Here is whereby the owner wanted to start a business with 5,000, but he went and took the money into the bank and saved it there. So into the bank. So the bank is the other account that is involved. So we have the bank account. So these are the 2 accounts involved. That's step number 1. So let's move on to step number 2. Step number 2 is we need to identify the account, the giving account and the receiving account. If you don't know the giving and the receiving account, you cannot move on to the next step. So you need to identify the giving, the receiving account, and the giving account. And the giving account. Now, according to the first transaction, that capital is always given, and they say obviously given. So you don't need to know both. Identify the giving, obviously the other one will be receiving. So you should not disturb yourself to know both the giving and the receiving, because sometimes it is easier giving. So it's easier, you take that one, then obviously the other one will be the receiving or the giving. So now, we have here, according to the law, capital is always given. So capital is the given. And if capital is the giving account, I don't need to tell you. Obviously, the bank will be the receiving account. So here, the bank is the receiving account, and the capital will be the giving account. We move on to the last step, and that's where we are, and this assignment is based on the last step. But the reason why I give you recap is you cannot able to do or solve the last step, which is identifying the account to be debited and account to be credited, without understanding the first principle and the second principle. So I told you the first principle is we identify the account involved. The second one is we identify the giving and the receiving. the third one is, then after identifying the receiving and the giving, then the third step will be, we are going to debit the receiver. If we debit the receiver, obviously we are going to credit the giver. So you see, is the final step. Obviously, if you come to that level, because you identify the giving and the receiving, then finally, after identifying the giving and the receiving, we're going to apply the last step, which is we are going to debit the receiving account and we credit the giving. Now, I am going to use these 3 steps in order to solve this assignment. I think you need to write down what are the steps you need to follow in order to get your double entry principle. So now the first one we have, the first identifying accounts involved in the transaction. The second one is identifying the receiving and the giving. Identifying the receiving and the giving will help us to apply the third step, which is the third step says we are going to debit the receiver or the receiving account and we are going to credit the giving account. So with the help of the step, we can able to apply the third step. Now, let's look at the assignment we have on the screen. So we start with the first transaction. The first transaction says, started business with 5,000 in the bank. So the 2 accounts involved there is, we have capital and bank. So as I told you, sometimes it is easier to identify the giving than the receiving. Sometimes it's easier to identify the receiving than the giving. So here they say in the bank. So obviously if they said I put my watch in the bucket, obviously the bucket is receiving the watch. So here they said the money that was invested by the owner was kept into the bank. So here the bank is receiving, or we can look at the other scenario in accounting. They said anything that increases the value of the asset, debit, and anything that decreases the value of the asset, credit. Bank is an asset. So if money is put into the bank, obviously the value of the money in the bank is increasing. And when the value of the money in the bank increases, the law says we are going to debit that asset. So here, we are going to debit. Obviously, if I know that the bank account will be debited, and then I don't need to even bother because there are 2. If you identify the account to be debited, obviously the other account will be credited. So we have A. We don't need to write the question again. We have the transaction A. So we have started business with, so capital is the giving and bank is the receiving. So we have bank and then we have capital account. So that is the first transaction. So let's move on to the second one. B, sold office furniture by check. Sold office furniture. We are selling office furniture. Office furniture is fixed asset, and after selling the office furniture, we are receiving check. So what is happening? What is happening here to accounting? They said when you asset, there is not sale exists when it is sold goods. Sold goods. So this problem. That is why sometimes we have errors of principle because students did not understand, because they thought that anytime they hear the word sold, it is sales. It's wrong concept. Whenever we hear sold, it is not qualified to be sales. There is something that makes it to be qualified to be sales. It is goods. If there is no goods, obviously there must be students will be skeptical on which account should exist. So here they say it's sold office furniture. Office furniture is going, and then they are receiving bank. So obviously, the 2 accounts involved is office furniture and bank. According to accounting, check is represented by an account called bank. So obviously, whenever we see check, we should know that it is called bank account. There is nothing like check account. There is nothing like sold account. So the 2 accounts involved is furniture and bank. So now, after identifying the account, that's step number 1. So let's move on to step number 2. We need to identify the giving and the receiving. Then after identifying the giving and the receiving, then we move to the last step, which is we debit the receiving and credit the giving account. So now, here, let's see which one is easier. So sometimes in double entry, we credit what is good and we debit. So if you look at that concept, here we are selling office furniture. Office furniture is going. And then what is happening? Bank is receiving. So the check is coming. So here, if I apply that concept, obviously I will know which one is the giving and which one is the receiving. And here, according to that, office furniture is going, is giving here, and the bank obviously will be the receiving account. So therefore, that is step number 2. We identify the receiving account, which is the bank, and we identify the giving account, which is the office furniture. So what do? We move on to the last step before we record it on the table. The last step is we debit the receiving account and credit the giving account. So the receiving account here, that's letter B. The receiving account here is the bank account. And the giving here is office furniture. So let's move to C. Letter C says, bought machinery 1,800 on credit from Karim's. We have here also is the same principle we can apply when it is sold. Sales is when it is sold goods. The same thing applies for purchases. Some people thought that anytime they see bought, it is purchases. Not correct. Purchases only bought goods. Put this thing at the back of your mind. That's why sometimes students have what we call error of principle as well. They thought that anytime that I buy, it is always purchases, which is wrong. It is not purchases. So purchases exist when they say bought. They said purchases are goods bought for resale by the business. So therefore, according to that transaction, we need to first of all apply the first step, that is to identify the accounts involved. And here, according to the question, the accounts involved are machinery account. The other one is from Karim's. So Karim's is the one, is the other account. So that's step number 1, identifying the accounts that are involved. So now, let's go to that is identifying the receipt, the giving. Remember, I told you, sometimes it is easier to identify the giving. In English, when I believe anything that comes after the word from is always the giving. And anything in most cases that comes after the word to is always the receiving. Transaction, they said, we are buying machinery from Karim's. So Karim's here is the giving account. Karim's is the giving account. If Karim's is the giving account, we don't need to ask. Then machinery will be the receiving account. That is step number 2. Number 3 is we debit the receiving account and credit the giving account. So which one is the receiving account? That's receiving account. That's letter C. So we are going to debit machinery account and Karim's account will be credited because it's the giving account. Now let's go to letter D. Letter D says, bought motor van paying by cash. Here also the same thing. You see, if you understand one principle, one concept, you can generalize it. Anytime that you see bought, fixed asset, there is nothing like purchases. That anytime that we have such, we should not record it as purchases. They can say it bought premises, bought land and building. So they are just changing the name, but the concept remains the same. Because they said bought fixed asset. So there is nothing like purchases account, it's the fixed asset account. So here, let's apply the first principle again. The first principle said identify the accounts involved. 1, we have motor van account. Motor van is there, we have motor van account. 2, we have cash because they are paying cash. Motor van giving out cash. So the other account is cash. That's step number 1, identifying the accounts involved. Let's go to step number 2. Step number 2 says, identify the giving and the receiving. So let's look at which one is the easiest. Whether the giving is the easiest, is easier than that of the receiving, we need to look at that one. So here they said bought. What are we buying? Motor van. So motor van is coming. What is going, obviously. If you will access to the motor van. So here, sometimes accounting debit in and out. So here the motor van is coming in. Or if you look at it aspect of the principle, which says that anything that increases the value of the asset, you debit. Anything that decreases the value of the asset, you credit. Motor van is an asset, cars is an asset. But motor van is a fixed asset, it doesn't matter, they don't classify the fixed or current asset. So both of them are talking about the same thing. So motor van is an asset. In motor van, what happens to the value of the asset? It is increasing. So cars is going, the value of that cars is reducing. So if you look at these two assets, one is increasing in value and one is decreasing in value. So the one in value, according to the law, increase in the value of asset, we debit. Motor van is increasing in value, going to debit. So obviously, what happens to cars? But we are paying cars. For instance, the business was having 10,000 cars, and all of a sudden they took 5,000 to buy a motor van. So what happens to the value? It has reduced from 10,000 to 5,000. So you see, the value of the asset is reducing in that aspect. So what did the law say? Reduction in the value of fixed assets in general, we are going to credit. So here, the last step is that the giving account here is cash and the receiving account here is what? Is motor van. So we are going to debit. We have motor van account, and then we have what we call cash account. So we go to letter E. They say bought goods on credit from Mabintu. Bought goods on credit from Mabintu. You see the difference now? Here they are not saying bought fixed asset. They are not saying bought machinery. They are not saying bought motor van. What they are saying is bought what we call goods. So according to the accounting principle, they said whenever they say bought goods, the account that exists automatically is the purchases account. So what is the other account? Is Mabintu. Mabintu. These are the two accounts involved. Mabintu's account. So now that is step number one. Step number two, we identify the giving and the receiving. So which one is the giving here? The giving here is Mabintu. They said we are buying it from Mabintu. So Mabintu. And what is happening, they said purchases here obviously will be the receiving. So the giving account here is Mabintu's account and the receiving account will be purchases. Then what is the last step? We are going to debit the receiving account and credit the giving account. The receiving account is purchases account. Mabintu will be Mabintu's account. So we have the next one is, that is letter F, sold goods on credit Salima Ba. So the two accounts we have there is, we first of all need to identify the account. So the two accounts we have was sold office furniture, but here they say sold goods. Because of his sold goods, the account that exists will be sales account. And there they said what? They are selling the goods Salima. So obviously the other accounts will expenses. Expenses and asset, they have the same law. Anything that increases the value of the asset. Which is one of the most important topics, and it is part start the topic proper. I of the concept behind the topic and what are some of the things that students would put into consideration, because what I came to realize is that there are a lot of students who normally start a topic. They did not know the reason why the topic existed in accounting. They did not know what are some of the things that are involved before they even start the topic. So, statement. Before we even start defining what bank reconciliation statement is and what is bank statement, but we need to know what are the types of account or types of bank accounts that are involved and what is a bank. First of all, I need to tell you what is a bank. A bank is a financial institution. It's a financial institution. Institutions that normally keep deposit sources or valuable assets of an individual. So now, if you look at under the financial system, bank is classified as what? A financial intermediary. They serve as what? Between the investors, those who invest, that's the investors here as a financial institution, and then we have the borrowers. So you see the borrowers that will come to the bank and they will request money on loan basis, but before they will access, they have to make sure that there is money available. So the bank will serve as an intermediary so that they can collect deposit of investors. After collecting deposit of investors, so they can keep it there for anybody who wants. One of the source of revenue for a bank is interest on loan. They give out loan and they will attract the loan. So bank is a financial institution, and bank also serve as a financial an intermediary between the borrowers and the investors. To start the topic will be that types of bank account, and type of bank account involved is called statement. We have main types of bank account. We have bank account. The first one we have is called the current account. So the current account, this is an account that is normally opened or established by a businessman or businessmen most of the time, or other individual or group of individuals not frequently use money. Because under the current account, if you open a current account, the owner of the account, that is called the current account holder, can withdraw money anytime that he or she feels like. Time that the business want to collect money, they can collect it frequently. That is why they say under current account, one of the most important features is current account doesn't have any interest. Because if you save 1 million into the bank, it is not safe for the bank to take that money as your deposit and give it to somebody. Because under current account, you can save 1 million and you can collect it anytime. So the bank will not be taking your resources or taking your deposit and giving what the money. So current account, because of that, you see current account doesn't attract any interest. It doesn't attract any interest. And the other feature of current account, normally if you open a current account, you are given what we call checkbook. So one of the checkbook. So you are given a checkbook, and this checkbook is not for free. It's called cost for check. The cost of a checkbook. If you want a checkbook, and you have to pay for it in order to get the checkbook. So under current should what we the other depositing under current account, you use what we call pay-in slip. Pay-in slip. You use the pay-in slip for deposit in cash. For deposit, you use the check for withdrawal. So you see, on the current account, if you want to deposit, you use the pay-in slip. On the current account, if you want to withdraw, you normally use what we call a check. So checkbook, the checks are used for withdrawal. The pay-in slip are used for what we call for deposit. Now, the other type of bank account we have is what we call the savings. So savings is where non-income earners or income earners can able to save their money for a little period of time. But in the Gambian, I think the banks are deviating from that principle, because now you can have a saving account, you can collect the money, but that is not the purpose of the saving account. The purpose of the saving account is earners to save their, so that anytime that they need it, they can able to collect it from the bank at maybe after a small period of time. One attracts small interest. There is interest attached to this interest, and this you are given what we call a passbook. You are given a passbook. If you want to deposit, there is something that we call a deposit slip. You are given what we call a deposit slip. If you want to withdraw, you can use what we call a withdrawal slip on the same. So they will book where your transactions will be recorded. And if you want to deposit, there is what we call a deposit slip. You normally go to the bank, collect the deposit slip. You put what you want to deposit there, write all the details, then you deposit your money. If you want to withdraw, that is what we call withdrawal slip. So you are going to collect the withdrawal slip, write the details, everything you want to write, then you issue it to the bank, and the bank will give you the money you want to withdraw. So the last one is called the fixed deposit, or we call it the time deposit. Under this one, normally you're given a certain period of time for you to collect your money. You save your money for a specific period of time. When the time period elapses, you can go and collect your money. So these are the three main, and this one attracts larger interest. This one is small, but this one is large interest. You save your money for a certain period of time, and when the time elapses, you can go and collect your money from the bank. So these are the three main types of bank account. Our topic outline or objective will be, or we're going to learn in objectives will be, the first thing we need to discuss is the definition of bank reconciliation statement and bank statement. The next one is the reasons for the differences. The other one will be the reasons for preparing bank reconciliation statement. The other one will be format for preparing bank reconciliation statement. The next one will be methods in setting questions. And the last one will be how to prepare the adjusted cash book and bank reconciliation statement. So I hope to believe that by the end of the lessons, you will understand all what is on the learning objectives. So now, the first thing they will ask you is, what is a bank statement? So if you look at a bank statement and bank reconciliation statement, the first part of the definition you need to consider is, when you are asked to define bank statement, one, we have bank statement, and the other one we have bank reconciliation statement. This one is called the BS, and this one is BRS. So bank statement is a statement. You can say it, this is a statement. Or normally, sometimes you can replace a statement as a document. Bank statement is a statement or a document. This one also, they have the same introduction. Bank reconciliation statement. It's a statement or a document. So you see, they have the same introduction. So the next one is, after the first part of the definition, this is prepared by who? This is prepared by the bank, and this one is prepared by the current account holder. Current account holder. Sometimes some people will say to write a customer is not correct. You know, it's not bad to write a customer because those current account holders are customers. So sometimes the reason why some people, they don't want you to use customer, because if you say a customer, it can be a customer for savings, it can be a customer for fixed. And under this topic, normally is current account that is existing. So that's why we call them current account holders. But if you say customer, meaning probably you are generalizing it. But if you want to be more specific, you need to write current account holder or the account holder, because the account holder of that one is the current account holder here, because we are applying under the type of bank account which is current account. So now, this is prepared by the current account holder, and the bank statement is prepared by the bank. That is the second part of the definition. If they prepare it, they send it to what? Send to the current account holder. These people, if they prepare it, they send it to the current account holder. But for the bank reconciliation statement, because of it's the customer that is preparing it, for them, if they prepare the bank reconciliation statement, they normally send it to the bank. That's the third one. They send it to the bank. These people send it to the current account holder because it's prepared by the bank. These people, they send it to the bank because it is prepared by the current account holder. That is the third part of the definition. So what is the last part? That's the the most important one, which is like, why do we prepare the bank reconciliation? To show the transactions between the bank and the current account holder. So this one is prepared to show the transaction between, it doesn't show the transaction between the cash book and then the bank statement balance. Please, it shows the balance between, it shows the transaction between the bank and that of the current account holder. Some people, they misinterpret this. We reconcile the cash book balance with the bank statement balance. We did not show the cash book balance. The purpose of this one is to show the transaction that has been happening between the bank and then the current account holder. So now, because of here there's a reconciliation, the last part is that the purpose of this one is to reconcile. Reconcile what? The disagreement. The disagreement. Disagreement between what and what? The disagreement. The disagreement between the cash book balance, and the bank statement balance. So please take note. We reconcile the disagreement between the cash book balance. We don't reconcile the disagreement between the bank and then the customer. We reconcile the balances between what? The cash book balance and the bank statement balance. So you will see, I will tell you the reason why we even have this topic, because sometimes at the end of the period, normally the business would like to balance up their, and when they balance up their cash book, sometimes they request the bank statement from the bank. And if they request the bank statement from the bank try to print the bank statement. They print the bank statement, so the in the cash book with the bank the balance that they have in the bank statement. So if they compare it and realize that the balance do not agree with the balance in the bank statement, so therefore there is a disagreement. And what do we do as accountant? If there is a disagreement, we identify the causes of the disagreement. After identifying the causes of the disagreement, then finally we normally reconcile the disagreement. Where reconcile, it means that there is a misunderstanding, there are differences, there are disagreements. So those disagreements need to be reconciled so that the relationship will continue. So therefore, if you are defining bank statement and bank reconciliation statement, you can just categorize it like this. I just want to make it simple for you. There are four main parts that you need to be very careful of. The statement or document. This one also is a statement or document. The second part is that who prepared the bank statement? Is who prepared the current bank reconciliation statement, the current account. The third one is SEN. If this bank prepared it, they send it to who? They send it to the current account holder, which is the customer here. And this customer prepared it, they send it to who? They send it to the bank. Then the last part is they show the transaction. So between the bank and then the current account holder. That's the here. The bank reconciliation do not show, but rather reconcile the disagreement between the bank cash book balance and then the bank statement balance. Now let's look at the definition we have for bank statement. I'm just trying to describe this so that students will know they can easily master. So master how to do within a short period of time. Sometimes when we are different things, it is very important for us to compare and see, and it will help us to understand it. So now, we have, this is a statement prepared by a bank, for its customer or a current, showing the transactions between the bank and the account holder. So the transaction that includes the definition. So sometimes they will ask or they will ask you to explain. So you need to go further. So we will stop here for these lessons. Again, in the next lessons, we continue from where we stop. Thank you so much for your attention.